You're listening to Let's Get Surety. Let me hear your bonding talk with Kat Shamapande.
Hey everyone, it's Kat Shamapande. Thanks so much for joining us for this episode of Let's Get Surety. I am so excited to have with me today Chris Lafakis. And Chris is going to be talking with us a little bit about an economic outlook. Hey Chris, before we dive in, can you tell me a little bit about yourself and about Moody's?
Yes, sure. So my name is Chris Lafakis, and I'm a director at Moody's Analytics, and I specialize in macroeconomics, energy economics, climate economics. And at Moody's Analytics, we provide tools, data, and forecasts to firms to help them with their risk management.
We were honored to have Chris as a presenter at our East meeting back in October of 2025. And when we talked with Chris then, the predictions were, the baseline was that we were not going to be going into a recession. So I'm excited to find out if that's still where we are or if anything has changed since October of 2025. So Chris, it's great to have you on. Thanks for being on with me today.
Oh, it's my pleasure, Kat. Thanks so much for inviting me. Yeah, this is an opportunity to check in with how some of the predictions have fared. I'm happy to report that the U.S. economy has not fallen into recession since I presented to the group. So,
I feel like that's going to make everyone listening feel good.
So, yeah, I mean, or else we'd be in bad shape if it only took through 2 or 3 months for the prediction to not come true.
Yeah.
Yeah, but by all accounts, there's no evidence that the U.S. economy has fallen into recession since then. That's not to say that there aren't cross currents in the outlook that and have been over the last few months as well. And happy to talk through many of those, but I'll kind of refresh my prediction from October and say that the most likely case, the base case as of now, is that over the calendar year of 2026, we do not expect the economy to fall into recession again.
That is great news. So you mentioned there's some things that have changed since then. What are those? What are the key things that you've noted changing?
Well, the labor market still remains the principal concern for the U.S. economy. We are simply not creating jobs at a very fast pace. The trend rate of job creation has fallen to, I would put it at between 25 and 50,000 jobs per month. And that, by the way, is well below what is typically needed to keep the unemployment rate steady. Okay. Because there's new entrants into the labor market every month. There's people that are graduating college and looking for jobs. There's, teenagers that are looking for something to do over the summer. There are international immigrants that are coming in from other countries, both in terms of, professional background and non-professional background. And so those are new entrants into the labor market. And we also have people who are exiting the labor market. If you reach retirement age, you're falling out of the labor market, or if you become unemployed and have difficulty finding a job. And so the net of those is kind of what I would say is the net labor force additions every month. And that has historically been on the order of 100 to 150K per month. And so if you want to keep the unemployment rate steady, you need to be creating at least that amount of new jobs, or else your unemployment rate will tick higher. Now, the good news for the job market is that I guess you could call it good news, is that we don't need as much job growth in order to keep unemployment steady, because those labor force additions have been much less over the last year and a half than they were in years prior. And there's multiple reasons for that. And I discussed some of them in October, but happy to mention them now.
Yeah, we'd love that.
Yeah, absolutely. So, we have downshifted in the rate of international in-migration. And that is, number one, illegal, or I would say not legal, workers increasingly being detained or deported. I would say that overall that is a pretty small number. And I think what's more relevant is kind of the reduction or cessation in the flow of non-legal immigrants into the labor market. Going back to the prior administration, you had a lot of in-migration that was not of the kind of textbook variety. We were creating 200,000 jobs per month. So, your unemployment rate was still stable and that's a question of, well, what kind of economy do we want to have? Do we want to have an economy that's growing, jobs at 200, 250K per month and the unemployment rate being steady, or growing at around, 50K per month, but not having as much an international contribution to the labor force? So that is a challenge. I would say that since we talked, AI has continued to blossom into a huge deal for the labor market and the economy. We've seen the number of workers employed by tech firms decline, actually, over the past 6 to 12 months. And that goes to the ease with which companies have been able to rely on AI to generate these productivity gains and not have to hire as many workers in professional service industries. And so I think that part of the contribution to the slower rate of job growth can be pointed at the weaker in-migration, but it's also AI and, us not needing as many jobs as we did in the past because our productivity growth has strengthened because of this new wave of AI. I would say that I was more concerned with the uncertainty that was created by the U.S. tariff policy in October than I am now. I think we've gotten a little bit more clarity now than we had in October about the future direction for U.S. trade policy. Some of the last countries have agreed to trade deals with the U.S. That India is the most notable one that happened recently. Switzerland also agreed with the U.S. And, you also read some reports like the administration dialing back on steel and aluminum tariffs and Congress voting to undo the tariffs against Canada. That probably won't go anywhere, by the way, because you would need a 2/3 majority to, overcome a presidential veto. But it at least sends a message. And we do have also the Supreme Court ruling to look forward to on the legality of the White House to use IEEPA. That's the International Emergency Powers Act that was put in place in the 70s. They've used that as justification for some of the tariffs that have been put in place. If it turns out that the Supreme Court rules against the White House on that front, then, the White House might move to reestablish tariffs under another pretense, but it also sends another signal that there are these institutional checks that are going to keep tariff rates at where they are or potentially lower. So that was another concern that I had. Also, public sector layoffs. That's something that I mentioned as well in October. I would say that the major realignment has already happened because with many of the, workers that were bought out of their jobs, they were given, and that this is back to, February, March 2025 when we had, DOGE at its peak and where federal workers were being bought out of their contracts. They would stay on the rolls until the end of the fiscal year, which was essentially the end of September. And so at that point, they would have to find a new job or become unemployed. And that created a bit of turbulence in the labor market at the tail end of 2025. But since then, that downward effect on job creation has lessened because you can only be laid off once. And then, some of those people, and then some of those people have found other jobs, in the private sector. So that, I would say, we've worked through the uncertainty with trade policy. I think we have worked through. Unless there's, a new surprise on the horizon that is not being telegraphed right now. The foreign immigration is still an obstacle for the rate of job growth. These political preferences on whether or not it's a good thing or a bad thing, but just speaking from an econ's perspective, it's lower numbers of job creation, lower numbers of labor force growth, lower numbers of in-migration. And then lastly, that AI concern that I mentioned, that is, kind of here to stay. I mean, if it's intensifying, if anything, because we've gotten just new readings on the rate of job and job growth by industry that paint a difficult picture. And I think that, when these new technologies are implemented, there's always a disruption in the short term, but then there's opportunities in the long term that no one would have thought of. Take a web designer, for instance. You go back to the 1970s before the internet, and that was not a profession, but now it is. And there will eventually be new jobs created by AI that we have a difficult time identifying now, but they will happen. And I mean, maybe it's as easy as, someone who, if you want to create a profession for them, determines the best way to implement AI within each company, because we have millions of establishments in the United States. And it really needs to be a bottoms up effort, not a top down effort, in order for each firm to integrate AI in their products and services, in their internal processes, to create the best opportunities and experiences for their customers. And that's something that has to be done, across the board in every industry to really take advantage of what the technology can do. And perhaps that's the new web designer, who knows?
Yeah, it's interesting that there's jobs out there that we don't know are going to exist, but will be out there in the future. I'd write an article talking about how a future career might be being counselor or psychotherapist for AI that's going to need to talk out its problems from dealing with all of us, I guess.
Yeah, that's like the reverse.
I don't know if that's
of that
true,
movie.
but it's an interesting thing to think about.
Yeah, I remember that there was a movie with, an author, I think it was Joaquin Phoenix and Scarlett Johansson, and I don't want to spoil the movie for everybody. It's a good movie if you haven't seen it,
No
but
spoilers.
maybe it's the flip way, where it's the AI that needs the talking sessions.
Yeah, exactly. Well, I actually had a question. You were talking about the job growth slowing down and how AI has impacted specifically the tech industry and job growth there. Are there any other industries that are being hit harder by this slowdown in job growth, or is it kind of across the board?
Yeah, it's interesting. This wave of technology, I think, makes it easier to replace or not hire, or whatever you want to call it, workers, office workers, professional service workers, just because there's so much that potential customers have at their fingertips with AI searching capabilities and the integration of new software within their company, and the proliferation of things like ChatGPT and Copilot. I really do believe that those are the workers that are on the front lines for not having their jobs filled when they leave, or just downright replaced or laid off. I think that it's going to be harder to replace people that are doing physical work, that are manufacturing, or that are building homes, or that are, harvesting crops, or doing carpentry or electrical work, all of these things, because sure, those workers get enhanced by AI. They can have access to more information that allows them to do their jobs better and make more money per hour, increases in their productivity. But at the same time, this is a proliferation of information in a unified fashion. It is not the robotics revolution. I think when you have robotics, that threatens, the kind of working class industries. What we have right now is more for office workers that can be more easily replaced. But I mean, if you can have, a robot, for instance, that is armed with AI that can wash dishes or harvest crops or, build homes, then that would be, the threat to these kind of more technical industries. We're not there yet. I don't think we will be there for some time. I know that there's interest in taking AI and harnessing it and packaging it into robotics, but it's just not there yet. It's hard to say what the time frame will be on that. I think that that's certainly a technology that many firms will be working on in the future, and perhaps at some point down the road, and maybe in our lifetimes or maybe not, there will be robots that are performing jobs like this, and that would have significant implications for the labor market. But right now, I think it's professional services firms. And, these are still, jobs, and you will still be able to find jobs in these firms. I don't want to say all the jobs are gone. I just want to say the rate of job creation within those industries will be diminished by AI. We're still going to need doctors. We're still going to need lawyers. We're still going to need people to answer phones, at call centers or at healthcare facilities. We will still need all of this back office operations for retail outfits and leisure and hospitality and so on and so forth. The people working at, your Hilton or Marriott or whatever. We're still going to need all of those people, those industries, but it's just going to be a diminished rate of job growth because increasingly with productivity gains, you have more productive workers. You don't need as many workers to generate the same output. And I think that's where you'll see kind of most of the disruption from the current AI trend.
Okay. Well, and looking beyond job growth, are there any other factors that could threaten or pull the U.S. economy into a recession if things weren't to stay the same that we should be paying
that's
attention
a good question.
to? Yeah.
Very good. Yeah, very good question. So, along the lines of AI, I just want to take that and extrapolate it to your question right now. AI has accounted for that. If you just look at the 12 largest tech firms and the amount of capital expenditure that they are doing and compare it to all the capital expenditure that's happening in the US since 2022, since ChatGPT came out, it's about 90% of all new CapEx is being done on AI. And that is that affects GDP, right? Investment is one of the inputs into GDP, and it shows you the degree that firms are, putting capital. They believe that this is the next big thing, and it's either, evolve or be left behind. And so a tremendous amount of investment is occurring in the AI space. If that were to dry up, then you would get a hit to GDP growth. Also, the equity market has been buoyed tremendously by AI. There's been a lot of stocks that have had a lot of success, that most of the increase in their valuations recently has become because of this phenomenon. So it has helped out the stock market. It's helped out the real economy. You see data centers going up. You see power plants getting restarted. New power plants coming online, all of that is related to AI. If all of that were to go away, if you were to have kind of like an AI bust where, investment dries up, fewer data centers are being built, less power is going up, and you have, layoffs for AI-centric firms, and at the same time, a significant correction in the equity market, then that all of a sudden threatens. That's enough of a hit to undo the expansion. That would actually cause a recession. So I think that is, and you would need actual job loss. It's like, we had 2001 where there was a significant correction in equity markets after the kind of the dot-com boom, but a lot of that was equity. It wasn't kind of people taking on debt, leveraging their personal balance sheets, and then having a decline in the asset value, going underwater, having to go bankrupt. That's what happened in 2008. In 2008, and that was a different shock, by the way. That was subprime mortgages, right? But then it affected the entire financial system. In 2001, you had a huge run up in equity values that then corrected. So people lost in terms of their equity, but they didn't lose assets that they had accumulated only through debt issuance. And that was a big differentiator between 01 and 08. Nowadays with AI, it's hard to know how much of this run-up has been fueled by debt or equity. I think that it's mostly been equity, and so that's easier to survive than if it's kind of debt fueled. But if you start to see, layoffs, then even if it's equity fueled, that will get you into this negative self-reinforcing cycle where, consumers lose their jobs, they are not spending, firms are then seeing contracting revenue, further reducing their headcount, not providing as much compensation, and that further reduces spending and corporate revenue, and the cycle goes on, right? And it becomes negative and self-reinforcing very quickly. And there's also a confidence component that is related to that, the so-called loss of confidence on the part of both households and businesses can accelerate this trend. And so that's the concern. If you kind of have all of these things, with AI happen, it either puts people or businesses out of business or leads to layoffs that undermine the spending, then either of those could cause a cessation of the economic expansion.
Well, so we've kind of you've talked through some of the things that could happen that could send us into a recession. Even with some of the uncertainty out there or things that could change in a more negative way, are there opportunities out there based on where we are as well?
Yes, absolutely. So I would say, number one, monetary policy has continued to ease, and this was in line with what our expectations were that we presented in October. We haven't really changed our view on monetary policy. The Federal Reserve has continued to cut interest rates. It held steady last time, but we do think there's going to be another rate cut or 2 or 3 this year because, as I mentioned, the rate of job growth is quite weak. The inflation rate is, I would say, maybe a little bit on the elevated side. We had 2.4% CPI last print. That's a good number. If that holds year over year, that would be exactly on par with what the Fed is looking for, because they usually target 2.5% on CPI and 2% on PCE. And if that that all clear is there for the Federal Reserve, then that allows them to focus on their unemployment rate mandate and provide additional assistance to the labor market, potentially help the housing market and consumer demand for these big ticket durable goods like washing machines and appliances and televisions and whatnot. So I would say that is a positive. I mean, it is consistent with what we thought would happen, but it has been a positive. And you will see that help the housing market. Housing mortgage rates have fallen. The demand for refinancing has increased. Goes hand in hand with mortgage rates. And so the lower mortgage rates will boost housing demand, and by making it more affordable for people to own a home. So that's the second positive, is kind of the implications, the knock-on implications for the housing market of lower mortgage rates. The third positive that I would kind of point to would be fiscal stimulus. So we have, and this was something that we had anticipated in October as well. Our view hasn't changed in terms of the boost to the U.S. economy in 2026 from fiscal stimulus. But you have One Big Beautiful Bill Act, which provided a number of advantages in the tax code for people in different kind of areas of the economy. So you had the Social Security tax cut that was part of the no tax on tips, no tax on overtime, no tax on car loan interest. You had business deductions. You had SALT cap going from 10K to 40K. All of those fiscal stimulus provisions will add about 0.5% to GDP growth in 2026. And that benefit will start to fall off in 2027, but it's really going to help the economy in 26. It's going to be harder for the expansion to come to an end. So I think, another thing that I would point to as a positive, and you still have, growth that's coming from AI. It is a risk, but it's also a driver. And it is boosting spending via the wealth effect. We've had some hot parts of the equity market correcting of late. Crypto and tech being kind of examples of that.
Definitely.
on the margin, the S&P is still kind of run up. I will add one more positive.
Oh, great. I like the positives.
There's one more positive, and that is the depreciation in the value of the US dollar. I mean, I guess positive depending on whether or not, you're traveling abroad anytime soon.
Yeah.
I mean, if you've got a trip lined up to Europe, this summer, you're probably not happy.
Might not be great. Yeah.
Yeah. You're probably not happy the dollar is 10% lower than it was at the start of 25, but at the same time, it makes American products more attractive internationally. So that's, making it cheaper for international tourists to come and enjoy the United States, and it's making it cheaper for international customers to purchase U.S. goods as well. So that, I guess, it cuts both ways, right?
Yeah.
If you're kind of loving to travel to other countries, it's probably not the best news for you. Your dollar can't go quite as far, but it does help exporters, U.S. exporters here at home.
If you were to zero in and look at the construction industry specifically, is there anything outside of what we've talked about that you think people should be aware of, either, as a risk or as an opportunity?
Yeah, so I think you want to watch the mortgage rates and watch the housing market. We've had pretty weak demand for homes lately where, sales are down. But a lot of that is because people are, the so-called lock-in effect, where people are not even entertaining putting their house on the market because if they move, then they'll have to pay a lot more in mortgage interest. And the other thing is kind of weak demand because, with the mortgage rates that have been for most of the last year above 6.5%, it just hasn't been as attractive, but with mortgage rates falling down, I think the last reading that I saw was, and this podcast will come out after a bit of time from when we're recording, by the way, but if they can stay at it's 6%, if they can get that low or stay kind of in the low 6.1s, then I think that's going to be a shot in the arm for the housing market and for construction. The other thing to watch is the rate of in-migration because, when you have more households, you need more homes. And whether or not it's single family or more multifamily, it doesn't matter. You still get a boost to housing demand. So that would be the other one that I'm watching for on the demand side, which is, do we still have very restrictive in-migration? What's happening? Are people getting deported and all of these things on large numbers? Because that could impact demand for housing and household formations. So that's the key for the construction industry.
That's so interesting, Chris, because I've heard the in-migration issue come up a lot related to construction and employment and, having the teams to do the construction work. But that's a different way to look at it and how it can affect the construction industry. It's really interesting.
Yeah, and that's on the demand side. I think on the supply side, I think it's going to be up to state and local governments more than anybody else will regulate the, zoning. They'll control zoning restrictions. They'll control whether or not what firms need to do to be allowed to build in certain areas. A lot of those are obstacles to housing supply in certain parts of the country. So I would keep my eye very closely on those on the supply side. And yeah, I mean, that's about it. I mean, you have your demand for housing, you have your supply constraints, and then you have mortgage rates. And those are the three major factors that I'd be looking at for the construction industry.
That's great. Well, if you had a crystal ball, Chris, and you could look further into the future once we get beyond 2026, what do you think we'd see there?
Well, I think that the outlook for 26 is going to be better than 27. I think that 27, you're going to have, as I said, the fiscal stimulus is going to fall off. You will have, if we are boosting, housing and other parts, interest-sensitive parts of the economy via lower mortgage rates, lower interest rates, then what that could lead to is consumers leveraging themselves, which is good for the economy at the time that loans are taken on because it's spending, but if you can't service the debt over the long term, then it becomes a problem. So I would kind of, it just feels kind of like we're in the early stages, like the 05, 06. If I'm in a parallel to the global financial crisis, it feels kind of like we're in the early stages. But, if you have a lot of kind of good times and spending and borrowing that occur that is more than people can service reliably in the future, then that could cause a problem down the road. At the same time that you're getting kind of, there's a loss in income because crypto prices are down, or stock prices are down, or maybe the AI boom isn't fueling the equity market like it has been. So it's just like more of an opportunity for the kind of positive factors that I mentioned to kind of play out. And then if you don't have those as kind of headwinds for the US economy in 26, then, where's your growth coming from? And if it can't be all powered by AI and productivity, then, you could get into a situation where, growth becomes anemic. So I think that the outlook for 26, I feel pretty good about 26. There's a number of things going in the right direction for the economy, but then I would worry a little bit more about 27 and 28.
Okay. Well, maybe we'll get you back on again in 27 and 28 to give us an update, Chris.
Yeah, absolutely. Happy to do it.
Thanks so much for being on. It's been great just getting an update on how things have changed since we talked to you last in October at our fall meeting, and just getting an update on the economic risks and opportunities that are out there.
Oh, it's my pleasure. It was a great time at the fall meeting, and thanks for having me on again to discuss the U.S. economy. Happy to do so.
That's great, Chris. Thanks so much.
Absolutely.
You've been listening to Let's Get Surety, brought to you by the National Association of Surety Bond Producers. For more information about the NASBP and its members, visit nasbp.org.